Right now, traditional Wall Street investors are buying up 2008 level crash insurance. I mean, they are terrified.
Absolutely terrified.
Yeah. Yet at this exact same moment, billions of newly minted digital dollars are just flooding into crypto,
Yeah.
setting up this massive mechanical trap that could violently launch Bitcoin to like $85,000.
It is quite the setup.
It really is. So welcome to the deep dive. Today we're unpacking a really fascinating financial analysis that lays out this looming explosive short squeeze thesis for you.
Right.
We're going to look at the severe macroeconomic fear that is currently paralyzing traditional portfolios, why crypto is unexpectedly acting as a sponge for all that fleeing capital, and the precise mechanics of why the market's heavy betting against a rally might actually act as rocket fuel for one.
It's just a brilliant paradox to unpack, really, because, to understand where Bitcoin and Ethereum are potentially rocketing toward, you can't just look at the crypto charts.
Right, you have to look outward.
Exactly. You have to understand the bizarre, highly contradictory state of traditional equities right now, specifically the S&P 500. The crypto resilience we are seeing is a direct reaction to that Wall Street panic.
And looking at the data we have, I mean, that Wall Street panic is hiding in plain sight. Let's look at the S&P 500.
Let's do it.
The index recently closed below its December minimums, dropping about 2.5% this year. But simultaneously, it is hovering only about 5% away from its all-time highs.
Yeah, it's a tight squeeze.
Very. If you're managing a portfolio right now, that is an incredibly tense, claustrophobic space to operate in. But how does a market drop below its recent minimums while still sitting practically at the ceiling?
Well, it comes down to market breadth versus market cap weighting. The S&P 500 is heavily weighted toward, a handful of massive mega cap tech stocks.
Right, the giants.
Exactly. If those few giants hold their ground, the index looks totally fine on the surface. But if you look under the hood at the market internals, the foundation is kind of rotting.
Which the data points out.
Yeah, the data highlights the McClellan oscillator, which measures that exact breadth, how many individual stocks are actually advancing versus declining. And right now, it's flashing an extreme oversold signal.
So what does that usually mean?
Historically, when breadth collapses this hard while the headline index is still near all-time highs, you're basically looking at a coiled spring. It often precedes really expansive, violent moves as that tension finally snaps.
But the people managing the big money aren't positioning for a violent move upward, are they?
Not at all.
Right, because if we look at the options market, the sheer volume of downside protection investors buying put options to hedge against a total market crash is just staggering.
It's off the charts.
It really is. The hedging has hit levels completely disproportionate to a 2.5% drop. We're looking at the highest levels of crash insurance buying since the 2008 financial crisis.
Which is saying something.
Yeah. It's eclipsing the panic we saw during the tariff wars. And the fear index is locked at a reading of 21, which is deep into the extreme fear territory. I mean, it's like watching your neighbors buy the most expensive premium hurricane insurance available, boarding up all their windows, retreating to a bunker.
When there's only a light drizzle outside.
Exactly.
A light drizzle.
But from their perspective, the radar shows a Category 5 storm forming right off the coast. The macro headwinds validating this fear are pretty brutal.
Like energy, for example.
Right, look at oil. It's up 70% this year, grinding dangerously close to $100 a barrel. And high oil isn't just a number on a screen. It functions as a massive, unavoidable tax on global consumption and manufacturing.
And that's not the only headwind.
No, add to that the implosion of private credit markets, regional banks suffering heavy outflows. I mean, the finance sector is down 11%, and former market darlings in AI and software suddenly dropping.
So the foundation of the traditional growth narrative is really cracking. It is, and the geopolitical data layers right on top of that. We're tracking severe ongoing tensions, specifically the deployment of U.S. ground troops to the Middle East, which instantly bids up oil futures as the market prices and supply chain disruptions.
Right, and it's fascinating to look at the political data points here too. Specifically, the analysis tracking recent statements from Donald Trump pushing for immediate interest rate cuts from Fed Chair Powell and, prioritizing winning the conflict over managing the price of oil.
And we should probably clarify something here for the listener.
Yes, absolutely. Just to be super clear to you listening, we are entirely impartial here. We do not take any political sides, left or right.
We're strictly reporting on the data.
Exactly. We are just looking at how these statements are impacting market sentiment in oil futures as outlined in our source, stripping away the politics entirely because the market itself does not have a political party.
It doesn't.
Right. We can actually measure the real-time probability shifts. The moment those statements hit the wire, algorithms reprice the likelihood of sustained structural inflation.
Precisely. Because the market is just a discounting machine. It's calculating the probability of the Federal Reserve being forced to cut interest rates in an environment where global conflict and $100 oil are simultaneously driving inflation higher.
Which is a terrible combination.
It is that exact cocktail that has traditional finance totally terrified.
So if you're looking at your own portfolio right now and you're seeing private credit implode and oil nearing $100, you're probably wondering why smart money hasn't just liquidated everything into cash.
Well, because in an inflationary environment, sitting in cash guarantees a loss of purchasing power. You can't just hide under the mattress.
Right, inflation just eats it.
Exactly. So instead of a flight to cash, we're witnessing this massive, highly strategic capital rotation. The traditional market is flooded with inflation risks, so capital is actively hunting for alternative safe havens.
Which leads us to the most counterintuitive data point in the analysis.
The resilience of crypto.
Yeah, and I really want to push back on that because the historical playbook says when traditional equities panic and credit tightens, highly volatile risk assets like crypto are the absolute first things to get dumped.
Usually.
Right. Institutions usually run to gold, silver, or treasury bonds. So why is crypto behaving like a sponge for this fleeing capital right now?
Because the infrastructure of crypto has fundamentally changed. The on-chain data reveals that capital isn't just fleeing equities, it's actively rotating out of physical safe havens.
Out of physical safe havens.
Yeah, we are seeing large entities, whales, taking tokenized gold and converting it directly into crypto ETFs.
Okay, let's hover on that mechanic for a second. We aren't talking about someone selling physical gold bars waiting for a wire transfer to a bank and then funding a crypto exchange.
Yeah, not at all.
Tokenized gold means the asset is already on the blockchain. So these entities are using smart contracts to swap digital representations of gold directly for Ethereum, bypassing the traditional fiat off-ramps entirely.
It's a massive paradigm shift in how institutional liquidity moves. It's a frictionless rotation.
Wow.
And the destination for that rotation is crucial. A major catalyst here is the new BlackRock Ethereum ETF, which introduces staking.
Staking changes everything.
It really does. Traditional Wall Street isn't just buying Ethereum to hold it in a cold wallet. By wrapping it in an ETF that stakes the underlying asset, they are turning a traditionally sterile digital commodity into a yield-bearing instrument that competes with treasury bonds.
Which fundamentally alters the supply mechanics. If you're locking up that Ethereum to secure the network and earn that yield, you are actively removing it from the circulating supply.
You're engineering a massive supply shock.
Right. Traditional Wall Street money pours in, locks up the asset, and the float available for anyone else to buy shrinks drastically.
Exactly. The liquidity is drying up. And we can see the institutional footprint confirming this behavior on-chain.
Oh, through Cumberland.
Yes, the data tracks that major institutional market maker, Cumberland. They recently withdrew $50 million worth of crypto assets off major public exchanges like Binance and Coinbase, moving it entirely into private cold storage wallets.
And when you pull $50 million off an exchange order book, you are not setting up for day trading.
No, you're not putting limit orders in.
You are taking your chips off the table and locking them in the vault. I mean, that is heavy, long-term accumulation.
Right. So you have capital rotating from gold into ETFs and institutions hoarding the underlying assets, which builds an incredibly strong floor under the price.
But a strong floor isn't enough to cause a huge spike.
Exactly. Low supply alone doesn't cause a violent price surge. To trigger the explosive upward targets we're looking at, the market needs a massive, sudden wave of demand. It needs raw, fresh liquidity to hit the order books.
And if we look at the blockchain right now, a multi-billion-dollar wave of demand just woke up. The stablecoin printers are running red hot.
They really are. If you want to understand where the momentum is shifting, you follow the stablecoin flows. They are the liquidity engine, the digital powder waiting to be deployed.
And the influx right now is staggering.
It is. Circle, the issuer behind USDC, has minted over $8 billion since February.
$8 billion. And the velocity is what really stands out in the data for me. Circle recently minted $500 million in a single day.
Yeah, $2 billion over a 7-day period.
Unbelievable. And Tether, the largest issuer in the space, which had been completely dormant, literally out of the game for over a month, suddenly powered on and minted over $1 billion.
Just woke right up.
Yeah, This is not retail investors dollar cost averaging a piece of their biweekly paycheck. This is the equivalent of casino managers wheeling literal pallets of cash directly onto the trading floor.
And those pallets of cash aren't minted to sit idle. They're minted to execute market buy orders. They provide the bidding power that chews through resting sell orders.
But here's where the paradox locks into place. If the institutions are hoarding the supply and the stablecoin issuers are flooding the floor with billions in fresh buying power, who exactly are they betting against?
Well, they're betting against the extreme Wall Street fear we established at the very beginning. All of this fresh liquidity is entering a market where the vast majority of retail traders and hedge funds are heavily, aggressively betting that the price will go down.
The short sellers.
Exactly. And this creates the perfect mechanical storm for the core thesis of our deep dive today, the technical short squeeze.
The anatomy of this squeeze is just fascinating because it's driven purely by market plummet.
Okay.
Let's look at the derivatives data.
Sure.
We're seeing open interest rising rapidly, which means the total amount of leverage and borrowed money in the system is expanding. But simultaneously, the funding rates are completely red.
Which is a huge tell.
Right. When you combine high leverage with deep red funding rates, it tells us the market is entirely polarized on the bearish side. Traders are taking out massive loans to short the market, betting the rally is a fake out, and a crash is imminent.
And the analysis vividly notes that these short holders are, quote, completely in the mud.
I love that phrase.
It's accurate. They're sitting on heavy realized losses as the price stubbornly refuses to drop, largely due to that institutional floor we discussed earlier. And this is where the mechanics of a squeeze turn incredibly violent.
Walk us through that violence.
So when you're heavily leveraged on a short position and the price begins to tick up even slightly, pushed by that fresh stablecoin liquidity, your broker will eventually intervene.
To protect themselves.
Exactly. To prevent your losses from exceeding your collateral, the exchange's risk engine will force liquidate your position.
And a forced liquidation isn't a polite request to exit the trade. The risk engine executes an automated market buy order. It does not care what the price is. It just buys the asset back to close the borrowed position.
It's ruthless.
It is. I like to think of a short squeeze like being in a crowded, panicked theater. Someone yells fire, but the only exit door requires you to buy a ticket from the exact person you just bet against. It's forced, indiscriminate buying.
And that forced buying is the ignition switch. The first layer of over-leveraged shorts gets liquidated, which triggers a wave of automated market buys. Those buys eat through the order book, pushing the price up another 2%.
Which triggers the next layer.
Exactly. That upward move triggers the next layer of liquidations, forcing more automated buying. It creates an artificial, cascading surge fueled entirely by the financial pain of people caught on the wrong side of the trade.
They literally become the rocket fuel for the rally.
They do. And the analysis maps out very specific liquidation clusters where this cascading effect peaks.
Right. For Bitcoin, the projection is a violent squeeze targeting the $76,000 to $78,000 range.
Yes.
And the sole purpose of that price action isn't organic value discovery. It's purely algorithmic hunting to clear out those short sellers.
But the data also highlights something critical about that $78,000 level. Above that, there is air.
Wait, air. Explain the air concept in terms of the order book mechanics.
So when an asset spends very little time trading at a specific high price, there's no historical price action to build up resistance. There are no trapped buyers waiting to break even and sell. The order book is incredibly thin.
Oh, I see.
So once the squeeze blasts through the heavy short liquidations at 78,000, there are virtually no natural sellers left to absorb the momentum. The price can easily glide through that air, hitting $80,000 or even $85,000 incredibly fast.
Wow. And it drags the rest of the ecosystem with it, right?
Oh, absolutely.
Ethereum is poised to break its current heavy resistance range, targeting $2,600 and potentially extending up to $2,760 as the Bitcoin squeeze provides cover fire.
Even the altcoin market.
Right. And traditional indices like the S&P 500 and the NASDAQ are expected to see a sharp, exuberant bounce as this massive broad market pessimism gets punished.
But we really need to pause on that word, exuberant.
Why is that?
Because a violent surge to $85,000 feels like total euphoria. It feels like the glorious validation of a permanent bull market. Yet, the analysis explicitly warns us to separate this short-term mechanical anomaly from long-term economic reality.
Got it. We can't confuse a broken pipe bursting upward with a structurally sound house.
Precisely. The macro reality is still incredibly grim.
Let's look at the actual economic output data to see that. U.S. GDP just came in at 0.7%. The market expectation was 1.4%. That is a massive structural miss, indicating the economy is rapidly decelerating.
And yet, as growth stalls, inflation metrics are still expanding.
Which is the textbook definition of stagflation.
Slowing growth colliding with rising prices. It's an absolute nightmare scenario for a central bank because the traditional tools conflict.
If you cut rates to save growth, you ignite inflation.
Right, and if you hike rates to kill inflation, you crush the slowing economy. The underlying fundamental problems that caused the 2008 level hedging haven't vanished.
No, they're very much still here.
The tensions in the Middle East remain unresolved. Oil is still hovering near that dangerous $100 threshold, acting as a dead weight on consumer spending.
So we essentially have two completely divergent realities playing out simultaneously. We're looking at a market that is temporarily defying gravity, not because the real-world economy got any safer or more productive, but purely because of its own internal plumbing.
Exactly. This upcoming rally, this potential explosive move to 85,000 for Bitcoin is an exuberant technical event. It's driven by algorithmic stablecoin injections, institutional supply lockups, and the forced liquidations of trapped short sellers.
It's not a sign that everything is fixed.
Absolutely not. It is not proof that the macroeconomic minimums have been reached. The analysis suggests the true bottom of the traditional economy, the real capitulation, may still be waiting for us once the dust from this mechanical squeeze finally settles.
It's the financial equivalent of a pressure valve snapping off.
Yeah.
It's going to be spectacular, explosive, and incredibly loud, but it does not mean the boiler isn't still running way too hot.
That's a great way to put it.
Well, let's pull all of these threads together, because the sheer mechanics of this setup are a masterclass in modern market structure.
They really are.
We started with a landscape paralyzed by fear, where traditional portfolio managers are buying up downside protection at rates we haven't seen since the collapse of Lehman Brothers. But ironically, that pervasive, heavy-handed fear has set a multi-billion-dollar trap.
A trap built by the market's own leverage. By aggressively borrowing money to bet that the system will crash, traders have unknowingly provided the exact automated buying power required for a massive upward move.
And the trigger for that trap is the Great Rotation. Smart money moving out of tokenized gold and straight into yield-bearing Ethereum ETFs, locking up the circulating supply.
Setting the floor.
Exactly.
Yeah.
Combine that supply shock with billions of dollars in fresh stablecoin liquidity hitting the order books from Circle and Tether, and you have the perfect mechanical storm.
The squeeze is on.
Bitcoin and the broader digital asset market are primed to violently squeeze upward, hunting liquidity and potentially shattering all-time highs, even as the long-term, real-world storms of stagflation and geopolitical tension continue to gather just over the horizon.
Which leaves us with a fascinating, almost unsettling question to walk away with.
What's that?
We just spent this time exploring how an asset's price can violently surge to unprecedented all-time highs purely based on the mechanics of punishing overleveraged traders and the sudden influx of algorithmic stablecoins.
Right.
If a market can move that drastically just based on its internal plumbing, are traditional economic indicators like GDP growth, corporate earnings, and inflation even driving asset prices anymore? Or have we crossed a threshold where we are now just trading the mechanics of the machine itself?
Oh, wow. That is a brilliant, lingering thought to end on. If the plumbing dictates the price more than the actual foundation of the house, the rules of the game have fundamentally changed for anyone allocating capital.
They certainly have.
Well, thank you for joining us on this deep dive into the hidden gears and liquidity traps of the financial markets. We warmly invite you back for our next exploration of the sources, where we'll keep peeling back the layers to make sense of the noise. Until next time.